All right, hello guys. Welcome to Sesky Trades.
Flame on. Flame on. Flame on.
All right, welcome everyone. This is week two of market structure. Just want to welcome you guys back to Sesky Trades. I'm your host, as usual, Sesky. So this is week two of market structure. Last week we spoke about what market structure is, but this week we're going to talk about how market structure fails. All right, we're going to talk how market structure fails. I know you feel different this week, at least you've gotten an overview of what market structure is. So this week we're going into deeper into market structure. All right. So let's go on this sweet ride. All right, the mechanics of structure failure. Let's prepare a PowerPoint view for you guys so that you guys can understand and read along with me and see what any topic I talk about is all about. So you can, if you don't understand me properly, you can always read from the screen. Okay. So and I find that to be easy and works. So today is not going to be too long. Okay. So the mechanics of structure failure beyond the break, the professional's view on market structure. By now, everybody knows what market structure is. The different types that we have, the uptrend, the downtrend, the sideways markets, consolidation, which is basically consolidation. All right, so you know what comprises the uptrend? It's comprised of higher highs and higher lows. All right, and for the downtrend, it's comprised of lower highs and lower lows. All right. All right, guys. Sorry, I was just having some little technical. I was just trying to check if everything was okay and if it was still working. But I can see it is still working. All right, let's go on. The most common sources of loss isn't what you think, okay? Most losses do not come from misreading the direction of the market. They come from believing a shift in structure early. This presentation is about learning when not to trust the chart. Do you understand that? So this presentation basically is about learning when not to trust the chart. All right, doesn't break. It confirms itself over time. I repeat, structure doesn't break once, it confirms itself over time. Structure doesn't break once, it confirms itself over time. Structure doesn't break once, it confirms itself over time. If you remember one and only thing today, just remember that the structure doesn't break once, it confirms itself over time. All right. All right. So before I continue, I just want you guys to look at this now. All right. See, this is my trading view. You can see this is my trading view. You can see that price. See the whole structure here. See the whole structure. Price isn't clean. Price is very, very messy. You can see, especially the newcomers here, the beginners. By looking at this, they will get confused. Price isn't clean. Price is messy. But looking at this, you can see that there's structure within this mess. There is structure within this mess. So let's get back. All right, so let's move on to the first trap. The first trap is the false break. All right, a false break occurs when price goes beyond the key level, only to fail to follow through. It is designed to lure in impatient participants. It is not confirmation. It is a bait. All right. You can look at this price action. We're on an uptrend here, on an uptrend here. Then price now moves up past a key level. You can say this is a key level. It now moves up beyond this key level. So we're now thinking that okay, probably this price is going to continue the uptrend. Then suddenly it comes down. All right. Suddenly it comes down and starts a downtrend. The reality. See, this is the base basically. This is the base conviction. The market tests belief before it rewards conviction. Okay. Or you can see two mindsets, two outcomes. The amateur, did it break? Enters immediately on the first sign of a break. Impatience, hope, and prediction. Then the professional, did it hold? Waits to see the market's reaction after the break. Patience, confirmation, and observation. These are the two mindsets. For the amateur, the beginner trader, you understand, is ocean. But for the professional trader, it's all about patience, confirmation, and observation. Patience, confirmation, and observation. One candle means nothing. Do you understand that? One candle means nothing. Let me pause there so you assimilate that. All right. Two mindsets, two outcome. I repeat again. The amateur will say, did it break? Enters immediately on the first sign of a break. Amateur is impatient, is trading based on hope and prediction. For the professional, he will ask, these are the questions you ask. Did it hold? And wait to see the market reaction after the break. Patience, confirmation, and observation. All right. So let's now move to the second trap, continuation. All right, continuation. When a strong trend begins to struggle, it is providing critical information. Momentum weakens, pushes become shallow, and movement slows. This is the sign of a potential shift. The market does not owe you continuation. Traders get trapped by trading the past, not the present. Reality of price action. This is not the reality of price action. All right, so this is an uptrend based on, you can see, higher highs, higher lows, higher is high, low, high here, high. Then suddenly starts reducing its effect. The pushes started becoming shorter. All right, you can see shorter pushes. Gradually, the momentum weakens, the momentum weakens, and it starts showing signs of, you can see, saying that the market might stop going on an uptrend. Okay, take note of that. So move on. This is not finished. Now, this is the anatomy of a true structural shift. A true shift in market structure is not a line on a chart. It is a demonstrable change in behavior. Structure shifts when the market stops doing what it used to do. Basically, all this is just big English. That's here. All right. So basically, what I mean by that is, once you notice that you're on an uptrend and there's just a shift, like I said, COCH basically, I told you guys this thing last week, change the market structure. Once you notice that, okay, the momentum reduces, and there's now a break of structure to the downside that breaks the flow, that means momentum has shifted. So you now wait for a confirmatory candle. Now wait for a not a confirmation, you now wait for confirmatory entry. I mean, all right, which price will now return back to another block. Then from there, you now know that, okay, this thing is going to go down. All right. If it doesn't break to the high set and still respects that level, doesn't go higher, then you know that, okay, the trade is going to continue on the downtrend. That is the true normative of a structural shifts, basically. So these are the few things. Let's go on. Reading the change in behavior. All right, you can see the strong push up here, then the weak pullback, strong push, weak pullback. All right, then you can see the pushes become weaker. Then a stronger pullback. This is now how you notice that it's changing. Because if you notice, you can see that, okay, change of character, broken the previous low. Hmm? Not even this one, self, because this is inner. This is So this is the major change of character after breaking the previous swing low. All right, to the downside. This is how you know a change of character. Okay, it pushes down past the previous low. A stronger pullback. This is when you know that, okay, this is a new behavior and the trend is changing. All right, the phase the old behavior, phase two the new behavior. This diagram is self-explanatory. The market speaks effort, not noise. The change in the relationship between pushes and pullback is the signal. The change in relationship between pushes and pullbacks is the signal. The market speaks in effort, not noise. The change in the relationship between pushes and pullbacks is the signal. All right, just study the diagram basically. Just study. You can notice from here, you can see the strong push, weak pullback. So this is an uptrend basically. But then it started reducing, momentum started reducing gradually, gradually. Now started going down. Yeah. This is the inner in the lower time frame. You can see if you check this in the lower time frame, there'll be lots of it's be a proper downtrend in the lower time frame in this region here. It's a proper downtrend, okay? So you can see weakening, then suddenly boom, it goes down. This is where you now know that uh, there's a change of character. All right. Previously, there were break of structures here to the upside, break of structures here to the upside, new higher highs being formed and higher lows. But suddenly it became a lower high, the first lower high, the next lower high. You can see lower low, lower low. All right. See the break of structure. It broke the previous structure to the downside. This is how you know that this is the structure of the market is changing. All right. The change in relationship between pushes and pullbacks is the signal. All right, you guys take that in. Remember, structure does not break once, it confirms itself over time. Structure doesn't break once, it confirms itself over time. All right, moving on. Now let's talk about the internal obstacle where traders miss the shift. The primary reason traders fail to recognize a structural shift is not ignorance, but bias. They continue to look for evidence that supports their existing position or desire, e.g., wanting is to be long, causing them to filter out or ignore signs of weakness. Do you understand? The internal obstacle why traders miss the shift. Most traders just because they are biased, they have this bias that said, okay, it's long. I want it to be long. You understand? They have that bias in them. So they tend to, because of that, it's in the brain, it's in the head. Because of that internal barrier that they have, they tend to miss the structural shift, the signs that shows that the market might be changing its structure. All right. And they will, because they want it, they feel, okay, I want it to go long. Yeah, it's going long. Boom, they miss those signs. And which, like you say, don't trade with emotions. Don't trade with emotions. You should always look out for those signs. You should always look out for those signs. The primary reason traders fail to recognize the structural shift is not ignorance, but you need to look for evidence that supports their existing position or desire, e.g., wanting to be long, causing them to filter out or ignore signs of weaknesses. Bias blinds faster than ignorance. Do you understand? Bias blinds faster than ignorance. Assimilate that. Yeah, read that, study that. You can screenshot that. Excuse me. All right, and so we've all done that now. The primary reason why traders fail, the tenor, I'll repeat it again before I move on to the next one. The next slide. The primary reason why traders fail is to first recognize structural shift is not ignorance but bias. They continue to look for evidence that supports their existing position or desire. Easy wanting to belong, causing them to filter out or ignore signs of weaknesses. Okay. When structure is unclear, patience is strategy. I will repeat that again. When structure is unclear, patience is the strategy. Market transitions are messy. They do not offer clean signals of perfect entries. All right. Market transitions are messy. They do not offer clean signal of perfect entries. During this period of ambiguity, the professional trader strategy is not to guess, but to wait. Inaction when deliberate is a position. All right. When structure is unclear, patience is a strategy. Market transitions are messy. They do not offer clean signals of perfect entries. During this period of ambiguity, the professional trader strategy is not to guess or wait. Inaction when deliberate is a position. So this is something that is very, very important. Patience, like I always say, patience is very, very key in trading. It's super key in trading. So rushing into trades, rushing into entries could be a very, very bad thing. And you could liquidate your accounts because you're entering at the very, very wrong time. Patience is very key. Wait for a confirmatory entry, basically. That's just it. Wait for a confirmatory entry. Wait for a confirmatory entry. Wait for a confirmatory entry. By the way, guys, remember my platform of choice for trading is it's LBank. LBank is offering various bonuses, and right now, if you get into LBank, with my link, and there's in the description of this live stream, you get into your bank, you get 50% rebates on every trade, on every trade. It's one of the best platforms out there. I love your bank for their innovation. Their user interface is very, very smart and unique. It's very intuitive. I love it. I love it. I love it. So you guys get it on L and enjoy your trades. Okay. So let's move on. When structure is unclear, patience is the strategy. Market transitions are messy. They do not offer clean signals or perfect entry. During these periods of ambiguity, professional traders' strategy is not guess, but to wait. Inaction is when deliberate is a position. All right. So take that in. All right. The decisive moment, reaction versus confirmation. All right. So this diagram just describes everything. All right. You can see it's on an option. All right, then an option. You can see impulsive trader sees the first break, jumps in and gets trapped. You can see he sees this, he quickly jumps in. But the patient trader waits and watches the reaction and lets the structure confirm. Basically, we are waiting for a pullback. Let it fall back to a point of interest, an area of interest. All right. And the point of interest or an area of interest, whatever you want to call it. All right. You wait for confirmatory entry. Wait for confirmation. All right. And this is it. And I said, okay, this is going up, then boom. But already for an impulsive trader, he just sees this and he jumps in. Yeah? Not nice. Not nice. Not nice. All right. So we need to be patient. Patience is very, very key. It's very, very key in this trading. One trader needs to be right, the other needs clarity. If you can see the difference, one trader is trying to prove to prove to be right, and the other needs clarity. All right. So you know who needs clarity? The patient trader. He needs clarity. The impulsive trader wants to be right. Yeah, my analysis is game. Is my analysis on point? I'm so right. I'm sure. Boom, jumps into the market. That's impulsive trading. The quicker you jump in, the quicker you jump out. All right, so you just have to be patient. You just have to be patient. All right, that's just it. Patience is very, very important and key in trading. All right.